Are cracks forming in the bull case for stocks? Let's ask our panel that question. Stephanie Link, Hightower's Chief Investment Strategist and Portfolio Manager. Cameron Dawson, Chief Investment Officer for New Edge Wealth. And Malcolm Ethridge, Capital Area Planning Group's Managing Partner. Steph and Malcolm are CNBC contributors. It's good to have everybody here. We start on the desk. Steph, what do you make of this sell-off? You could point to so many different things within this market. The rollover in momentum, the Palantirs, the AppLovins, the Vertivs, the trade desks, even the Walmarts. Even the Walmarts this week.
I know. I think a little bit of it is that we're seeing a little bit slower growth, to be honest with you, at like about 2.3%, the Atlanta Fed tracker. And I've said that I think this year we are going to see about 2% growth versus 3.4% that we saw of the last 2 years. And we're not going to see 20% gains in the S&P 500. We're going to see maybe more like normal, like 7 to 10%. And a lot of that is because we just don't have the fiscal stimulus that has been put in place over the last 5 years. We're not going to have it this year. The Trump administration is pro-growth, but they're not going to drive that growth by issuing a lot of money and putting money into the economy. They're going to hopefully figure out how to lower taxes and do more deregulation, and that is positive, but it's just not the juice that we have had. That's number one. Number two, yes, the momentum trade absolutely is rolling over. These stocks, this part of the market has had an enormous run over the last several years, and the valuations are really hard to justify. In the meantime, you actually do have pretty good earnings growth, but you have earnings growth in other sectors, Scott, that's just as good versus technology. In fact, some of the sectors are seeing better growth in earnings. And so you're seeing a broadening out, not only a broadening out with value beating growth, but you're seeing Europe up 10%, China up 20% year to date. And that's coming at the expense of the U.S., which is not horrible. We're still up 2%. There's still a lot of stocks that are up a lot year to date. But I just think it's prudent to take some profits where the valuations have gotten extended.
But this, Cameron, hasn't started like many people thought it would. This being the Trump administration 2.0 in the sense of what it's meant for the market. Almost everything is negative, by the way, since the inauguration. OK, the S&P is a fractional winner, 1/3 of 1%. That is it. Why? Because there's a lot of uncertainty over tariff policy, other parts of trade, global alliances in question, tax cuts. We think it's coming, pushed off, deregulation, still waiting. Signs that the consumer may not be as strong as we once thought. I want you to listen to a soundbite from the billionaire investor Steve Cohen. He was speaking at FII down in Miami about his view of where we are in this economy.
But the reality is you've got a brew of sticky inflation, slowing growth, and austerity in the government. And so I'm actually pretty negative for the first time in a while.
What do you make of that?
So when it comes to the economy, we do think that growth is slowing, to Stephanie's point. We think that there are these dynamics that feel a little bit staggy, given the fact that you have some signs of some resurgence in inflation in certain areas, growth slowing. That certainly doesn't feel as good as moderating inflation and really resilient growth like we've had over the last 2 years. We are not calling for a recession, so we don't see signs that growth is falling off a cliff. But when the market is priced at 22.3 times forward, when high yield spreads are at multi-decade lows, that leaves very little room for disappointment. And so when we think about what's driving the weakness that we're seeing today, it is a lot of the unwind of the most crowded, the most momentum names. Walmart went into its earnings season at 38 times forward earnings for a company that's growing earnings at high single digits, low double digits. So it's not all too surprising to see that positioning unwind, and thus the volatility that we're experiencing the last couple of days.
Malcolm, it's emblematic of the trade that's worked of late, a more defensive posture to this market. Staples, today, only group in the green. We know about Walmart's run. Discretionary stocks, weak, down more than 10% off of their highs. How concerned should we be by those two metrics?
Yeah, Scott, I think that sentiment overall, right? So you're talking about sentiment being reflected by names like Walmart telling us that demand is slowing and that the consumer is less confident. I think that that shift in the narrative has really been emerging for the last 4 weeks, right? So a lot of what we came into this year believing we could hang our hats on as investors is starting to unravel before our eyes. 4 weeks ago, we thought America was the leader by a long shot, all things AI. DeepSeek comes along and says not so fast. We thought that deregulation and M&A was on its way, and this year was going to be the year of mergers and acquisitions. Earlier this week, President Trump says not so fast. We thought that inflation was absolutely on its way down, and the Fed had no choice but to start cutting rates. CPI ticked back up to something with a 3 handle. Not so fast. So all of these different things that were the narratives we were so sure about coming into 2025 in the last few weeks have just started to pull apart. And I think that the sentiment shift probably continues into next week, even though we'll probably get some dip buyers early in the week.